Hi everybody, Alex Explorer here from Expert Forex, and in this video we're going to be talking about the skip strategy, but you'll also be seeing a few other techniques that are used to reduce risk when trading as well as reducing drawdowns dramatically. Now you see lots of pictures as you see on the screen, and I always used to think they are just marketing pictures, but I in fact did this for 10 weeks in the Mediterranean and I have never had better trading results. And many of our traders are reporting trading results that they've never experienced before. So let's have a closer look at the skip strategy. Now, about 3 weeks ago, we launched the Wave Liberator and the RSI Liberator. Fantastically successful EAs, and we were a bit cheeky because we launched them with no trading history. But the testing that has happened is reflected in these two videos that I made subsequently. Please go and watch them. You will be amazed at the success that's been achieved here. In this particular one, we're talking about 88 accounts that were profitable when this video was made. 88 out of 88. So these new robots are highly robust, but they do have downsides, but in this video I'm going to address those downsides. And the downsides are the EAs are generally all profitable. You can see these all started with $10,000 accounts and they are all nicely profitable, but they do have large drawdowns. There's a 7,000, 6,000, especially this week when the market was topsy-turvy. It just went all over the place, and hence the drawdowns. Now those drawdowns aren't too serious because the account is still positive, so it's a case of waiting for the profit retrieval process to occur, which I am going to show you further on. So one of the things we haven't really discussed since the launch of these EAs is the skip function, and the skip function basically is a way of reducing drawdowns and risk. And as you can see, we have a portfolio that we're testing, and you can see compared to the other portfolio that I showed previously, and let's have a quick look at that one again. Just look at these drawdowns, all in the 1,000, 7,000, 6,000, 4,000, 3,000. You look at the skip portfolio and we see controlled drawdowns, controlled floating losses. So, and also what's interesting is that the short-term ones are quite successful. There's a 5-minute, 15-minute, 5-minute again, 5-minute again, and so on. And then the ones that are lagging behind here are the longer term ones. The 30-minute ones are down here. So why is the skip portfolio generating these lower drawdowns? Now, in order to explain it, what I did is I actually designed an Excel spreadsheet where you can go and play around with the gap sizing, the multiplier amount, the skip level, and that is what we're going to be talking about today, and the initial lot sizing. And those are the key, very key. If you can balance those 4 items, you will have a life of luxury using the Liberator EAs. So how does the Liberator EA work? And this is basically a training session for existing users of the Liberator EA, but I'll just give you a bit of background. What happens with the Liberator EA? It identifies a trading signal and enters a trade. If that trade goes well, that's fantastic. It banks that profit like normal. But if it doesn't go well, it doesn't use stops. Basically what it does, it goes into what we call a profit retrieval process, which means it will open trades in the original direction of the transaction. Once the price has traveled a certain amount, it'll keep on topping up that particular transaction, and that to the extent that it requires a little small retracement to come out even. So when a trade goes bad, all you want to do is basically escape with a break even or a small profit. In fact, in most cases, it escapes with a small profit. So it doesn't use stops, it uses this profit retrieval process. Now, the problem with this process is it can build up big drawdowns. There's the drawdown for this particular one. Let me explain how this one works. So your initial transaction happens, then it travels 20 pips. In this case, because I've set it for 20 pips, it travels 20 pips in the wrong direction, so it tops up another one. It opens a new trade 20 pips later, and then 20 pips later, 20 pips later, and so on and so on. And what you can also do, if you want to, is you can increase the lot sizing. So you might start with 0.10 lots. The lot sizing can increase as you're going on. And why that is good is that it makes the recovery process shorter. And as you can see, there is a formula, and we'll have a look at that formula that calculates the break-even pips for these transactions, and you can see at the moment there it is 68 pips. So what has happened here? Let's say the price has gone negative by $120. That means the drawdown, if you're using 0.1 lots, would be 497, and you would need a retracement of 52 pips. So that's less than the 120, half of the 120. You would need a retracement of 52 pips, which is 43%, to break even. So that is what this model calculates, and that column there is a calculation which shows you that some of the transactions would be positive if it retraces 52 pips, and some of them will be negative, but in the end they all balance out. So we are going to be looking at ways of reducing the risk here. Now this is a picture, so I can actually go into one of the ways right away, and one of the ways is basically to skip, and that's where the skip strategy gets, skip some of the top-ups. So in other words, if we say we want to skip 3 top-ups, what would happen? The initial trade would happen, and then we just skip the next 3 trades. In other words, there will be no drawdown for those next 3 trades, and we then open the next one after the skipped 3. We open the next one as if those ones were open. So in other words, if you look at that transaction, 80. 1.5, it's the same. So we don't change the lot sizing, we just skip them, pretend they happened but they didn't happen, and that is what we call skipping. So what does this skipping do? Firstly, it reduces the drawdown tremendously. Here's one, you can see 497, here it is down to 211, so it's a reduction of almost 60%, much better. So that's the first benefit of skipping. The second benefit of skipping is the retracement is so much smaller. There we needed a 52 pip retracement from 120. It needed to go back, the price needed to go back to reach the break-even point by 52 pips. Here it only has to go back by 36 pips, which is a 30% improvement. So this little model can help you make up your mind what kind of strategies you want to use. And it is a free download in the premium forum. So let's go and have a look at this model. Okay, so here is the Excel spreadsheet here on an Excel program. And here we have exactly, I think, what you've seen before. There's the same statistics and things like that. But the program has been written in such a way that you can play around with the variables now. So, for instance, if you only wanted to go for 2 top-ups, you could do that, and it would just eliminate 2 of the top-ups. And then you can see the benefits have gone down, but the retracement, in fact, has gone up. So this is a fantastic tool to play around and see what will happen. Let's see what happens to the retracement if you only do 1. So the retracement gets for almost 40% better than before. So there's a whole lot of things you can play around with. Then with a multiplier, for instance, some people like to use no multiplier there. Oh, look at the retracement now, 44% better than the previous one. So this is the one we measure the differences against all the time, and you can see that the drawdown was better, but the retracement is so much easier to reach. Now, for instance, if you wanted to do a true martingale type of system, then you would multiply by 2. So you multiply by 2, and there's martingale, double, 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 double. There's the drawdown for martingale. The break-even pips is that. The retracement needed is only 19 pips. That's the benefit of martingale. Here, the drawdown is that. It's only 8% better, so not that great because martingale is pretty good. And then retracement needed is only 18 pips. So not a great improvement if you're using martingale, but the traders of the Liberty range generally use 1.1 as their multiplier, and that's where you get these more reasonable numbers. Still a huge improvement on drawdowns and a huge improvement on retracement to get to your break-even level. You can play around with the gap size. I like playing around with the gap size, so you can make that 40, for instance, and you can see what results would happen here. The drawdown is not as good as before, but it's 20% up better, and the retracement is almost 40% better. So you can start playing around now. 40 gap reduces risk considerably. It also gives you a longer range of open trades and so on. So you can go and play around with all of these settings. What happens if we make it 1.2? Then let's see what happens to the retracement. Oh, the retracement drops. So that's how you start developing a feel of the sensitivities between these major settings, which is the gap size, the multiplier, the skip level, and the initial lots. For instance, you could change the initial lots to also, and then see the impact of that. So this is a pretty handy tool to have. These calculations are based on a 6 top-up level. I will expand the model at some stage, but here's a 12 top-up level. So you can go and play around with a 12 top-up level, and you can say, all right, I don't expect a 6 one, I expect a 12. You can see the gaps actually go up amazingly to you covering a movement in the market of almost 500 pips. So your safety level improves tremendously, but there is a big drawdown. There's the drawdown, and the drawdown improvement is only marginally better, but I've only put 1 in. So let's go back to the 3 and see what happens there. And let's just put this back at 20, and let's put that back to a normal setting, and then we can get a better valuation of the 12 top-up level. Ah, look at the big difference it's made. The drawdown has gone down to 2,300. The retracement is now, you only need a retracement of 40, but let's have a look at the skipped calculations, and there your drawdown is 30% better in a long drawdown of 12 top-ups. So massive improvement on your drawdown, and also a massive improvement on your retracement. You actually instead of needing a 94 pip retracement, you only need a 76 pip retracement. So this model is quite a lot of fun. Please go and download it if you are a paid member of the Premium Forum, and please use it to plan your Liberty robot trading. I do recommend that you start experimenting with the levels of skip in quite a lot of detail, and start demo trading a couple of different strategies, different time frames, and so on. As you've seen, the 5-minute and the 15-minute show the best results so far, but you might find different results. Okay, to download this model, there will be a link in the description of the video as well as in the commentary of the video. And if you miss those links, all you do is you go to topics. This particular post will be one of the first topics that you see. It's called reduce your drawdowns by 60%, and that's how you find this download page. Now, I hope you found this video interesting and educational, and it has given you some ideas on how you can reduce your exposure to drawdowns. There are 4 major tools. It's the gap size. The bigger the gap size, the lower the risk and the lower the drawdown. The initial lot sizing, the smaller the initial lot sizing, the smaller the drawdown. Then we have the skip system, and there you have to look for a balance which gives you the best balance between risk management and drawdown management. And then the 4th item is the multiplier. You can use no multiplier, you can use a very small multiplier. I don't recommend a negative multiplier. Try and use a positive one that is 1 or better, and then look at the results, the impact of those decisions on your drawdown firstly, and then at the amount of pips that the price has to retrace to break even. So from me, Alex Deploy, cheerio.